most folks, don't really, fathom the tax implications of what retirement means. And, the responsibility now falls on you for each of those taxable events.
And welcome into Your Game Plan for Retirement, Northwestern Ohio's resource for a common sense approach to planning for your financial, investment, and retirement future is Chris McIntire, president and founder of McIntire Retirement Services. Chris, we always appreciate the information, the education, the insight, the guidance and advice, the knowledge of the financial world, how to get our money working a little harder for us. And today, going to be talking about a very important topic that unfortunately a lot of people get surprised by in their financial progress.
Yeah, taxation, and quick tip for the listeners out there is, retirement and taxes go hand in hand, right? Most people have been saving money into these big 401ks, and what are the tax implications that come out of that? The tax implications for Social Security. So, be prepared, get some education there. We need to work with somebody that can help you with your tax planning as you go through retirement to make the most of your money.
I think everybody would agree, Chris. It's better not to be surprised or caught off guard when it comes to taxes, right?
Yeah, absolutely. And sometimes people are because they may make a very big withdrawal from an IRA account, and some of those tax implications may come, next April 15th, and then even beyond that with Medicare premiums that are increased because of your taxable income that comes in.
I suppose I have been surprised pleasantly a couple times. Wow, that's a bigger refund than I expected. But even that is not always necessarily a good thing when it comes to taxes, right, Chris?
Yeah, you kind of typically want to work that balance where you really don't owe anything in and you don't get anything back because it's just a return on your overpayment with no interest in it. Now, I will say my dad loves to get a big fat return. For him, it's kind of been a forced emergency fund or a savings way. And, I'm not going to argue with him at 92 and a half years old.
Well, I know a lot of people use that for the vacation for the year, and maybe not the best way to save up for a vacation, but a way to save up for a vacation. Ladies and gentlemen, if you haven't picked up on it by now, we are going to be talking taxes on this edition of Your Game Plan for Retirement, how taxes really work in retirement, and what most people don't know or get surprised by. So if you've got questions, if you've got concerns, if you'd like to have that education so that you are not surprised by how taxes really work in retirement, stay tuned over the course of this program. Lots of important information coming your way. And of course, you've always got the opportunity to give Chris McIntire at McIntire Retirement Services a call and talk over your situation and get more personalized information and education. And most importantly, the plan put together, your game plan for retirement. If you'd like to start that conversation, it's a short phone call, 419-332-0532, 419-332-0532, 419-332-0532. So Chris, the perception, I guess, during our working years is once I get to retirement, that'll be the easy part, and I won't have to worry so much about taxes. But it's almost like the opposite in reality is actually true.
Yes, because there are some what do we want to call them? There's some holes in the bucket there, where money can leach its way through. Part of that could be Social Security taxation, where you're paying more than what you possibly need to, and then we look at the Medicare premiums, which is income based. My wife is on Medicare and Social Security, and so they take out nearly $600 a month from her Social Security benefit for her Medicare premiums because we have the business income in our household.
Chris, what I'm hearing in retirement, income is coming from multiple sources. You've got to be responsible for accounting for each one and aggregating them. During my working career, actually, this has caught me off guard before, in that I received income in the form of a W-2, which I thought was relatively simple because the taxes are already withheld. But what I guess didn't fully realize was that I needed to account for all household income. My wife also had her own W-2. And because I had not accounted for her W-2 and her income, and her withholdings were a little off. We were off together. And I guess the moral of the story, when you have multiple sources of income, just accounting for one of those is not the entirety of the picture. It's not going to do the job. Do people get surprised and caught off guard by the number of sources and how they have to sort of aggregate and account for all of them?
Yeah, and typically it's really in the first year or two of retirement because you go from W-2 where your employer had been withholding the taxes for let's say 30 to 40 years for a lot of folks, and then you transition into 1099 income. So that would be the withdrawals from the IRA accounts, and where you're determining how much taxes you want to have withheld, if any. Some people, you know. We see it both ways, Peter. We see people who say, well, how much should I withhold from my IRA distributions? And, say, okay, well, I don't, let's take a look at your tax return. What was the taxable income that we're looking at here? And they say, well, I think, it's probably 25%. And in retirement, for a lot of folks, it's nowhere near 25%. So, here in our marketplace, we deal with a lot of that 10% bracket and then into the 12% income tax bracket. So, helping people determine how much should be withheld from each of those IRA withdrawals or Roth IRA conversions, right? Because that's a taxable event, moving money from an IRA into a Roth. That's going to generate a 1099. And where do we get the money to pay those taxes? Do we do it on the conversion amount, or do we take money from like a checking or a savings account where there might be a surplus and pay the taxes with that? Okay.
Yeah.
And
A lot of people, Chris, I think, are under the impression that after retirement, you can't get money into a Roth. That is not the case. We'll talk about how to do that more into the program. But Chris, it sounds like, especially the last year of your working career to the first full year of retirement, which may be a period of actually a few years. You could have 1 year in the middle that's sort of half and half. But it sounds like this period is a lot of figuring things out, fresh and new. And I think that we might think of that from a what am I going to do with my time standpoint. But do you think that people put enough time into figuring out what financially is going to be different and what it's going to look like after that transition?
and it depends what they did for a living in a lot of cases. Most folks, don't really, fathom the tax implications of what retirement means. And, the responsibility now falls on you for each of those taxable events. And, so let's say somebody's even got money outside of an IRA account and a regular brokerage account. My wife and I have a large brokerage account, with after tax money in it. Well, you get a 1099 for dividends and interest that, comes from buying and selling of securities outside of that brokerage account. That's one that can get a lot of people as well too. They don't realize, how much I'm paying on passive income. Maybe they're not living off of the dividends and interest, but they get their tax return. And they're like, God, we had $20,000 of dividends last year that we paid tax on, and at 15%, that's $3,000 of capital gains taxes. So, the efficiency of taxation is something, we call ourselves a, kind of a tax geek, if you will. We want to help people, lower that bill, make those efficient decisions. And, many times, like my mom and dad, their income's low. We don't really worry about income taxes anymore. My wife's father, he just had very modest income, didn't even have to file income taxes. Today's baby boom generation has $1 million, $2 million IRAs, 401ks. So, tax planning is certainly taken on another element for essentially the baby boom generation that maybe the greatest generation may not have had.
We're talking with Chris McIntire, self-proclaimed tax geek. And ladies and gentlemen, I mean, that's what I think I would want to look for in a financial advisor, somebody who understands the tax implications of the investments and the recommendations and the accounts that they are helping to manage. And so often I think that piece of it gets ignored in the financial world and in the investment world. It's all about access to the market. Here's a handful of mutual funds. I'll watch over them for you and help you invest. That's important, but also understanding the tax implications and making sure that you understand the tax implications and are prepared for them. A big part of the total conversation and the picture there. So again, if you've got questions, if you would like to make sure that you're taking that perspective of understanding of how much not only you get to make, but how much of it you get to keep and spend, that is the game plan for retirement. And you can get that started. You can get that conversation started and get your game plan for retirement drawn up and constructed. No cost, no obligation. Give Chris McIntire and McIntire Retirement Services a call, 419-332-0532, 419-332-0532. All right, a little bit of a trick question, but Chris, something that on a surface level for a self-proclaimed tax geek would seem like it's a relatively straightforward question. So, Chris, should I withhold taxes from my Social Security?
Yeah, and it's not always that easy of an answer. The state of Ohio, we don't have to worry about state income tax on Social Security. The federal government does tax Social Security at different levels. So, last year they passed the One Big Beautiful Bill, and part of President Trump's marketing was he wanted to make Social Security income tax free. Okay, that did not pass. So Social Security is not income tax free for many Americans. If your income is very low and all you live on is Social Security, then it's very likely it's income tax free to you. But if you, have a take $50,000 a year out of your IRA account, right? You're going to start paying some tax on a portion of your Social Security benefit. So, I'll say it this way, nobody pays income tax on 100% of their Social Security. The worst case scenario is 85% of your Social Security could be taxable as ordinary income. So, and what we mean by that, if you're in the 12% income tax bracket, then up to 85% of your Social Security benefit would be taxed at 12%.
What I'm hearing, it's complicated. It depends. Not as straightforward as it might seem on the surface. And this is why, Chris, you need to deal with somebody who understands these nuances and these different bracket levels and income thresholds and the rules that apply, the taxation, the penalties, the income and how it fits into your total picture. I mean, in retirement, we're talking about Social Security, pensions, IRA withdrawals, Roth distributions, brokerage accounts and capital gains, interest and dividends, rental income. There are so many different potential sources that all need to be brought into the picture together, all need to be accounted for, and understanding how each is taxed. Each might be different. It might be fully taxed. It might be not taxed at all. It might be partially taxed. Social Security, should I withhold taxes from it? Not just a straightforward question. The answer, it depends, but for everyone, at least not all of your Social Security is going to be taxable. Very different, Chris, from your tax deferred accounts, those IRAs. A lot of people are like, well, now I'm in retirement. How do I avoid or mitigate taxes on my IRA? That is not a very easy question. I don't think the IRS is ever going to overlook or forgive all of that tax deferral that's occurred.
That's correct. Only the Roth IRAs are income tax free if you meet all the qualifying rules that they have for that. And so, you need to think about this Social Security thing because, let's talk about the early phase of retirement where, perhaps you have your Social Security income, your spouse's Social Security income for those that are married, maybe some pension income, and maybe that makes all, that's your basic living expenses, and you have some savings in the bank account or something. So if you needed extra dollars, you can pull from that. You're letting your IRAs and 401ks grow. All of a sudden we hit age 73 and that required minimum distribution kicks in. Okay. And if you've got, I'll just use $1 million because it's easy math. you've got to take out nearly $40,000. So now all of a sudden, you start paying income tax on that Social Security benefit. So think of it this way. Let's say somebody retired at age 62, took their Social Security, their spouse retired at 62, they took their Social Security, and they did not make any IRA withdrawals. Okay, so they most likely were paying very little tax on their Social Security benefit, if any. Okay, and then all of a sudden they get to age 73 and they pull out $40,000. Okay, so not only is that $40,000 from the IRA taxable, but up to 85% of their Social Security benefit could be taxable as well. So let's say it was $30,000, of Social Security benefits. Now you got to pay tax on 85% of that. What's that? Call that 27, $28,000 at 12%, or maybe that bumps you into the 22% bracket. And all of a sudden you got to pay a penalty because you didn't have enough taxes withheld. So that's one of the loopholes that gets a lot of people, and it can be frustrating without a doubt.
And then, Chris, eventually there comes a time where the IRS says, that's it, that's enough with this deferral. We would like to begin collecting our tax bill. And for some people, they're already living off their IRAs. And so
Mhm.
that is sort of a moot point. But for some people who have saved pretty aggressively and successfully and built up large tax deferred IRA balances, there comes this required minimum distribution, basically a forced taxable event. And I think the IRS thought this one through that not only are we going to start collecting, but those RMDs could bump us into higher brackets and higher rates, and they could trigger IRMA, which means your Medicare expenses also increase. It's like a compounding triple, quadruple whammy here if we have not addressed and thought through a plan very strategically for how to handle these RMDs.
Yeah, no question about it, Peter. And that's where those Roth conversion conversations, happen. And we do a lot of Roth conversions throughout the course of the year, a lot more than ever before. So, people are heeding the advice, clients are listening, because most of it is, I'm going to delay, and delay any taxation. And then all of a sudden, wham, I get caught with big distributions, and the law of unintended consequences can happen. And we're in a very favorable tax environment right now, with the passage of the one big beautiful bill. It helps a lot of retirees. So, now's the time to be taking advantage of some of these opportunities that have been bestowed upon us by the current administration, to give them credit, right? They cut taxes. And, obviously elections have consequences, and taxes could go up down the road depending upon the outcome of them.
Well, Chris, we teased it there earlier in the program about Roths, and there are a lot of people who are under the impression that once I stop earning income, I can no longer get money into the Roth. There really is almost never a time where it's completely impossible to get money into a Roth IRA. But we do need to do it with thoughtfulness strategically, but talk about those Roth conversions because there are multiple benefits there. Of course, there's a cost as well. As with everything in the financial world, there's benefits and disadvantages. So talk to us about once we are in retirement, there might still be a window of opportunity, a time and a place, and a justifiable reason to consider these Roth conversions.
Yeah, and I'll use myself as an example. I'm 60 years old, and my income is substantial after all these years of doing this. So now is not the time for me to take money from an IRA or a 401k and move it into a Roth. I'm in a much higher income tax bracket than I will likely be, once we call it a day and I'm 75 years old and chilling at home. So but for the average person who doesn't own a business and they retired from, one of our fine corporate entities we have here, and they're 65 years old and their income went from 150,000 to 50,000, right, in retirement. Now we look at, okay, in the current tax bracket you're in, how much room do we have before we bump into the next one? And does it make sense to take some money that's in an IRA that's going to come out as a required minimum distribution at age 73 anyway? Okay, and do we convert that now ahead of that time into a Roth IRA where it will be income tax free when you make withdrawals. Okay. And again, there's some rules that apply. We'll, worry about that on the individual basis. Okay. And then, that lessens the amount that's in the IRA, hopefully by the time you're 73. So those forced distributions could even be smaller. Okay. The Roth money that you have will pass income tax free to your beneficiaries as well, where the money in your IRA account is going to be taxable to your beneficiaries as they withdraw it, and they have a 10-year period to get that money out of there. And maybe they're in, at 60 years old. The last thing I want to do is inherit somebody's IRA account right now and pay tax at, let's just say, 40%, where in retirement, maybe I'm in the 22% tax bracket and keep more of that hard-earned dollars for sure.
Chris, I think a lot of people can probably give a pretty close approximation of the balance of their IRA account, but very few people have ever looked at or seen or calculated the taxes that they will pay on that account. How much will you pay over your lifetime on your account balance today? And I think that's where this conversation of managing taxes and Roth conversions can be so valuable. I mean, it can do multiple things. It can help you reduce future RMDs, reduce future Medicare premiums and IRMA. It can help to offset drop in survivorship income. And when somebody is widowed or becomes a widow or widower, they go from married filing jointly to single head of household. They go up in taxes. Wouldn't it be great to have a tax-free bucket to pull from at that point in time? And then finally, the legacy to beneficiaries. If we keep deferring and delaying, Uncle Sam has worked this out. He's going to be one of our largest beneficiaries. So multiple benefits here from having these conversations. And you mentioned it, but I think it bears repeating. It is a pay now or pay later system and setup with those IRAs. And not that we've made a mistake by deferring and delaying and building it up till today, but now's the time to sort of shift our thinking and manage that. And I have people ask me about the 5-year rule, Chris, like, oh, well, if I convert, I've got to wait 5 years. And my comment to that is the value is not in the conversion itself. The value is in the time after the conversion. So if we are considering moving money to Roth, like we would want to wait a period of time and maybe put those dollars in the back of the line, right?
Yeah, absolutely. And some of that 5-year rule depends on how old you are, So I'm 60 years old. I can convert money into a Roth IRA because I've had one that's been established for a long time, and you can always take out your converted amounts immediately. But like Peter says, look, you want to invest it and let it continue to grow.
Right.
And
Would that even make sense, right?
Right. Yeah, absolutely. Because, if you're paying 20% tax on that converted amount, you'd kind of like that to grow back to that original 20% anyway. And, and Peter, let's not forget, a lot of people retire early and then they go use the Affordable Care Act and go on the exchange to get their health insurance. And that is income based. So having, some money in a savings account or money in a Roth IRA that does not drive up your modified adjusted gross income, it certainly could be an advantage as well to a Roth conversion. So I call it looking poor on paper to get, some subsidies and some help on the health insurance premiums while we still have those loopholes in place.
Chris, that's a strategy that we need to have some forethought on. If we plan on retiring early, meaning before 65, before Medicare, but especially right before 59 and a half, we need to be having those thoughts and planning for that at 35 and 40 and 45 very specifically in order to have the optimal outcome for that early retirement.
Yeah, I'll give you an example. I mean, I paid $1,200 a month for my health insurance, and I just had a client in who's 1 year older than I am, okay, but has significant savings and can live out of that savings account, and her health insurance is going to be $275 a month.
Nice. Yeah,
and a lower deductible and everything than what I'm paying.
But plan for that in advance, I would assume.
Yep.
Yeah.
Yeah, absolutely. Yes.
And I know that like those non-qualified accounts, Chris, the non-retirement, non-IRA, non-Roth, we talked about all these pieces being different. Those are going to be taxed differently. Those are going to have capital gains. But I've heard of strategies for individuals that can have a pretty healthy income generated exclusively by those capital gains, but end up paying very little in taxes on them. And again, poor on paper.
Yeah, and I'm a good example. That's how I'm setting up my eventual retirement for Robin and I is, we have a lot of money in dividend paying stocks. Okay, so outside of an IRA account, so that's capital gains tax. Okay, that starts at 15% on the federal level. Okay, and it doesn't kick in until you're in the 22% income tax bracket. So, for some folks, they can have significant dividend income coming in, without it being taxed as capital gains. Maybe not all of it, of course, depending on how much money you're talking about. Where, does it make more sense to invest in dividend paying stocks outside of your IRA account because of the favorable taxes you may have on dividends versus investing in bonds that pay interest, which is taxed as ordinary income?
Yep. So we've been talking about taxes in retirement and how they can be a surprise to many people. Ladies and gentlemen, they should not be a surprise to you. You should have been educated and informed and thought through your strategies very carefully and specifically and have a game plan for retirement to deal with and address the taxes that you will pay in retirement. And that's why Chris McIntire is here, the self-proclaimed tax geek that he is, founder of McIntire Retirement Services, helping people understand, plan, and prepare for these things in retirement so that you can optimize your outcome. Give a call if you would like to put together your game plan for retirement. 419-332-0532. 419-332-0532. Chris, we've talked about a number of different tax strategies that work effectively here on the program. Roth conversion strategies in lower income years, tax efficient sequencing, making sure that we understand what accounts to tap first, second, last, managing those RMD dollars and the exposures, harvesting gains and using those for income, coordinating Social Security benefits and taxation. And then, Chris, I want to wrap up with maybe one of our best and most commonly overlooked strategies, one that is available for truly tax-free money. If we are charitably inclined, if we are donating to a church, a charity, a 501c3 after 70 and a half, we've got a pretty valuable and unique opportunity there that a lot of people miss.
Yeah, we absolutely do. And the ability to pass money on tax free is fantastic. And skip the IRS. And that's the beauty of life insurance as well, Peter. It's income tax free. We should, maybe you take your RMDs and you buy a life insurance policy that's got this huge benefit to it, income tax free for beneficiaries as well. So, to dump that in there. And I forget, what was your question, Peter?
The 70 and a half opportunity for nonprofit donations.
Yeah, qualified charitable distribution. Sorry, there I got off on that tangent.
You had a thought in your mind, and I've got actually one more about 59 and a half, and that being an opportunity for really starting to make this progress and do some tax planning. But Chris, hit on those real quick if you would for me. The QCD and then why 59 and a half is valuable.
Yeah, so at 70 and a half, so this is the old rule, you can take money from your IRA and pay it directly to a charity. So we call that a qualified charitable distribution. Qualified means it's got to be a qualified charity, a nonprofit, the Humane Society, schools, things like that. And, I think you can give, I forget what the number is for 2026, but, typically it's above 100,000. I think it might be 120,000, something like that, Peter, for 2026. I don't have my chart sitting in front of me. But that also then, when you're 73 years old, you can do some of your required minimum distribution or all of it to a charity as well and not pay tax on it. The charity gets it tax free. And then you brought up the 59 and a half rule. Okay, so most 401k plans have it where when you turn 59 and a half, you can do an in-service rollover into an IRA. Okay, or a Roth, and work your way into a Roth and start doing some of your pre-retirement planning, because 401ks may only have a number of different options investment wise, so a lot more flexibility outside the 401k world, Peter.
And you can do that tax planning. And as you've heard on today's program, ladies and gentlemen, taxes are complicated in retirement, not simpler. You need to have a plan for how to deal with them. Keep as much of your money as possible, get to spend your hard-earned dollars. And that's what the Game Plan for Retirement, your Game Plan for Retirement, will serve to help you accomplish. If you would like to get that plan put together, give Chris McIntire a call at McIntire Retirement Services, 419-332-0532, 419-332-0532. You can also visit online, McIntyreRetirementServices.com. Chris, great conversation. Let's not be surprised by taxes in retirement.
Yep, good to be with everybody today. Thank you, stay safe, and God bless America.
Tune into Chris McIntire's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.